Well, you have to keep in mind that November, December, and even some of January it tends to be a positive seasonal period in the for the calendar year. And I think it had a lot to do with interest rates. You mentioned it. I mean, we had a big decline in interest rates, so that helps fuel this rally. There's this optimism that the Federal Reserve is done and that interest rate cuts can be as early as the first quarter.
Tell us then, Megan, because next year, if the Fed is presumably going to be cutting rates, and a lot of this rally was driven on speculation that the Fed is done hiking, would think that stocks are just going to keep ripping higher.
I don't necessarily think that's the case because I think the market's gotten too optimistic on rate cuts. We think the Fed's going to probably reiterate here shortly that they're going to be higher for longer. Inflation is on the trajectory where they want it to go, but it's nowhere near where it needs to be. And the three things that they're focusing on, if you look at housing, if you look at wage inflation, if you look at service inflation, these things are still well above what the Fed wants them to be. So they can't get any dovish. And I don't think that the interest rate cuts that are baked into the market right now are going to materialize.
Wow. So where are we in terms of valuation then? I mean, the earnings period was okay coming out of the third period, but are we stretched here now on valuation? How do you think about that?
Yeah, I think valuations are stretched, especially in certain areas of the market. You know, when you look at technology or growth, these valuations are stretched, not so much in the small cap or mid cap area, but in that large cap, valuations are stretched. The earnings were good. I mean, we had a good earnings in the third quarter, but let's keep in mind the economy is really starting to slow. And we're seeing that now with some of the data we're getting into the fourth quarter. You know, ISM this morning was, again, 13th month down in contraction territory.
Yep.
And you look at things like employment and new orders, all these things are in contraction territory. So I don't think that's priced in. And the other thing is that I think the earnings expectations for next year and even 2025 are too optimistic. You're looking at double growth expectations for next year in earnings. I just don't see that materializing given the fact that the economy is really starting to slow here.
So, Megan, then what is your advice to clients right now? Is this a good time to maybe just, take some money out and, take those gains while you can?
Yeah, I mean, I would definitely reevaluate your portfolios and make sure that you have a good cash position on the sidelines. You're earning money on that cash now, so it's not the end of the world to hold that cash. I'd be careful being significantly overweight equities here. I think that the first half of next year can be very tough for investors from an equity standpoint.
So, and again, I guess just to take that to the extreme here, you can park your money in a 2-year treasury at 4.6, 4.7%. That's not the worst thing to do, is it? What do you think?
No, and especially because you have to, I honestly would just sit it in cash because the curve is still inverted. You don't have to lock it up for 2 years because I don't think the Fed's going to do anything anytime soon. I don't think that they have the ability to do anything anytime soon. So you're going to be able to earn that money there, but having that liquidity and that dry powder for when the market does turn and present some more opportunities, that's important, I think, going into next year.